Chapter 4 screencast is going to cover the closing process. The purpose of the closing process is to prepare the accounts for the next period, and this would occur after the financial statements are prepared. So for example, if you finished your accounting for the year ended December 31st, after you would prepare your financial statements, you would then prepare these closing entries. And we do this closing process for a number of reasons. Again, we're preparing the books for the next period so that we can get off to a good clean start. Some of the things that we're doing in this closing process: first, we're zeroing out the revenue and expense accounts so that each period's net income can be separately measured. If someone asked the question, how much money did we make this year, we would need to have that year's information in the revenue and expense accounts to be able to answer that question. And by zeroing out the accounts as part of the closing process, then we're separating those results for just that 1 year. The closing process also zeroes out the owner withdrawal account. You'll see below that that is also another account that we zero out, and it's called a temporary account that we'll discuss in a couple of minutes. In addition, the closing process updates the capital account balance for net income or loss and owner withdrawals. So we're also updating the capital account. The closing process follows the time period concept. It allows the financial statements to be prepared for specific periods of time, whether that be a month, quarter, or a year. A year would be the most common that we would have. We may also prepare financial statements each month. So the revenue, expense, and owner withdrawal accounts, as I've mentioned up above, those are known as temporary accounts. We use them for a period of time, and then we zero them out to start over the new period. You'll also read about those in your chapter. Assets, liabilities, and owner's capital accounts are known as permanent accounts. They are not closed. I want to give you an example of that. Hopefully it will make a little more sense. So say you have a checking account, and that would be an example of an asset. If a business had a checking account that they paid their bills out of, that would be an asset to the business. Your checking account is an asset to you. We would not zero out that account on December 31st intentionally, because we don't want to bounce checks if we have items that are going to clear the next year. So we would leave that money in the checking account, and that balance would still be there on January 1st. That's what happens with assets, liabilities, and owner's capital accounts. They're permanent accounts. They continue on in time. So if you close the day on December 31st with $5,000 in your checking account and no other transactions happen, when you start up on January 1st, you're still going to have that dollar amount in the checking account. Okay, so assets, liabilities, and owner's capital accounts all behave that way. We don't zero those out each period. We use the temporary account income summary to close revenue and expense accounts and to transfer balances to owner's equity. So the only time you'll see this income summary account is when we're going through the closing process. It's a very temporary account in that we use it to do these closing entries, we zero it out, it basically goes to sleep until the next time we do the closing process and we need to use it again. Okay, so in addition to the revenue, expense, and owner withdrawal accounts, we could add income summary to our list of temporary accounts. I thought it would be helpful to walk through the steps that we use in the closing process and just talk about those briefly. Step 1 in the process is we zero out revenue accounts. Here's an example. So say we have a service-based business. We would debit service revenue and credit income summary. And the reason we're doing this, think about a revenue account. We've talked about in previous screencasts, and you've read in your text and done activities on Connect about service revenue. What type of account is that? It's a revenue account. What's the normal balance of a revenue account? It's a credit. How would we zero out a credit balance in an account? We would have to debit it, right? So what we're trying to do is bring that service revenue balance to zero, and then again we're resetting that account to use it again in a future period. So our debit is to service revenue. We're zeroing that account out, and the credit for this entry is income summary. Again, we're zeroing out service revenue to the temporary account income summary. Step 2, we're going to zero out expense accounts. and I've got a brief example here. We would credit each of the expense accounts that we have. In this case, I've got rent expense for $1,500, wage expense for $1,750. Remember, expense accounts, what's the normal balance? It's a debit, right? So in order to zero out a debit balance, we're going to have to put an equal amount in the credit column to zero that out, okay? So that's why we've got these credits in the expense accounts. We're zeroing out those expense accounts. The debit, because our debits have to equal our credits. So the total, and we may have 5 or 6 expense accounts. I've just used 2 for this example. The total of all the expense accounts is going to go on this first line as a debit to income summary. So again, we're zeroing out these expense accounts and closing those out to the income summary. Okay. You would have to close out each individual expense account because you have to zero all those out to be ready for the next period and zero out the income summary. So let's take a look down here. We've made a couple entries up here to the income summary, haven't we? Step 1, we made a credit of $5,000, and step 2, we made a debit of $3,250. If I drafted a T account of the income summary, and I highly recommend this. I see students just trying to eyeball it, and they often get the dollar amounts wrong. So I'm a big fan of T accounts, if you haven't guessed already, and highly recommend you use them. So what I would do, if I were doing this closing process, I would draw a T account with the income summary, and I would record each of my adjustments. So this is step 1, where I credited an income summary to close revenue. Step 2, I'm debiting income summary $3,250 to close my expenses. And then I'm going to calculate the balance. My balance is a credit of $1,250. Okay? And the balance in this account, and again, I love to double check myself when I can. The balance in this account should be the net income or loss that's shown on the income statement. And I think it's a great idea to double check to make sure that what you're showing here is what you've got either as net income or loss on your income statement. In this case, because this is a net credit, this would tell me that net income on the income statement is $1,250. If I ended up with a debit balance here, that would mean I had more expenses than revenue, and I should be showing a net loss on my income statement. So those two numbers should be the same, your balance in your income summary and the net income or loss on your income statement. So let's move on to step 3. We basically have to do what we did up here with this T account to figure out this entry down here in step 3. Like I said, sometimes students try to shortcut it and just figure it out on their own. Sometimes they're successful and sometimes not. You definitely increase your probability of success by using a T account and working it out that way. So on to step 3. We're going to zero out the income summary to owner's capital. So remember I said this was a really temporary account. This is what it gets used for, and we're about done with it. So in our example here, we're going to debit income summary $1,250. And again, remember, up here we've got a net credit balance of $1,250. How do we get that to zero? We have to record a debit to zero it out. So our debit to income summary is $1,250. And again, that's the $5,000 revenue minus the $3,250 that we're seeing up here. My credit's going to be to owner capital. So I'm closing, this is the final, or we're at step 3 of closing our temporary accounts to owner's capital. Owner's capital is where these accounts end up, okay, these temporary accounts. So we've closed revenue and expenses and income summary to owner's capital at this point in time. We have one more step, and this step 4 zeroes out the owner withdrawal account to owner's capital, because remember the owner withdrawal account is another temporary account. Owner's capital, we're going to debit because we're crediting owner's withdrawals, and remember it has a normal debit balance like expenses, and in order to zero that out we're going to have to credit that account. So in my example here, the owner withdrawal account had a $500 debit balance. I'm crediting it $500 to zero it out, and my offsetting debit would be to owner's capital. Again, I'm zeroing out all those temporary accounts to my permanent account that is owner capital. At that point in time, all of our temporary accounts should be zero, and we have closed out all those temporary accounts to owner's capital. You'll see that another double check that you'll be able to do, I'm not going to cover it in detail, but that your ending balance in your owner's capital account should give you the activity that you see on your statement of owner's equity. Really represents the same thing. And your then at that point you can prepare a what's called a post-closing trial balance, and you would list all of your permanent accounts, and your debits should equal your credits just for your permanent accounts. And if they don't, you haven't closed out all your temporary accounts. So that's a good double check to make sure that you've closed all your temporary accounts out. And you'll see the post-closing trial balance and some of the exercises and problems in Chapter 4. Hope this has been helpful.